Hi everyone, we are going to review two problems in Chapter 7 for Master Budgeting. The first is going to be problem 717A on page 333, where we have Minden Company is a wholesale distributor of premium European chocolates. The company's balance sheet as of April 30th is given below. The company is in the process of preparing a budget for May and has assembled the following data in A through G. We are required to prepare a cash budget for May using that information, including a budget with the schedule of expected cash collection from sales and cash disbursements from purchasing merchandise. So in Part A, it says sales are budgeted at $200,000 for May. So we'll start with our sales, the cash receipts from sales. Of these sales, $60,000 will be for cash. So as you can see, the first item on our cash receipts schedule is cash sales, $60,000. It goes on to say the remainder will be credit, which would be $140,000. Of the credit sales, 1/2 of them are collected during the month of the sale, and the remainder is collected the following month. So 50% of the $140,000 credit sales will be included in cash because they'll be collected. All of the April 30th accounts receivable will be collected in May. Okay, and I'm sorry. And the remainder is collected in the following month. So the balance in accounts receivable is last month's sales that were not collected during last month, so they'll be collected during April. So the total cash receipts from sales, $184,000. Now in Part B, they give us information about the purchase of inventory. So let's take a look and see how we would do a schedule of cash payment for purchases. So the total purchases of the inventory are expected to be $120,000 during May, and they'll all be made on account. So none of them are cash purchases. 40% are paid in the month of purchase. So as you can see there, April 20th or May purchases, 40% times $120,000, $48,000 will be paid. The remainder are paid the following month. All of the April 30th accounts payables to suppliers will be paid during May. And all of the April 30th, so we will also include those as cash payments. So total cash payments are $111,000. Now, how will we create our cash budget? Well, we have to start with the beginning cash as of May 1st, which was $9,000 given in the problem. We'll add the cash collections from customers of $184,000 that we just determined. So the total cash expected to be available is $193,000. Of that, we already determined the amount of cash we will pay for inventory purchases. We did that above, $111,000. But let's make sure there's not other items that are being purchased. So take a look at D. Selling and administrative expenses for May are budgeted at $72,000 exclusive of depreciation. These expenses will be paid in cash. Depreciation is budgeted at $2,000 for the month. So $72,000 will be paid out as cash for our expenses. The note payable on April 30th. Balance sheet will be paid during May with the $100 in interest. All of the interest relates to May. Okay, so keep that in mind. A new refrigerator costing $6,500 will be purchased for cash during May. So you could see there, the purchase of equipment is included in total cash disbursements. So the excess of cash available over total disbursements is $3,500. Now, let's see how any kind of financing affects the company. During May, in letter G, the company will borrow $20,000 from the bank by giving a new note payable to the bank for that amount. The new note will be due in 1 year. So they're going to receive $20,000 in cash. But in letter E, they're paying off $14,500 of a loan that's currently on their balance sheet, the note payable of $14,500 plus interest of $100. So from financing, they have additional cash of $5,400. They received cash from a new loan, but paid off an old loan. So the net is $5,400. So how much cash will they have in total? $8,900. The $3,500 from their normal operations plus the $5,400 from new financing, or $8,900. So that's how we would prepare the cash budget for the month of May. Let's go to the next step, which is preparing the income statement. Now, the income statement is done according to accrual accounting, not cash, like we just did. So we're looking to see what are our total sales. And in Part A, they tell us they're $200,000. Then we're looking at what's our total cost of goods sold related to those sales. Well, remember, to get cost of goods sold, we would take, without it being given to us, inventory at the beginning, plus all the purchases made, whether they're paid for or not. So during the month of May, all the inventory that could have been sold had a total cost of $150,000. But some's left over. Some of it is left over. And they tell us in Part C, they expect $40,000 to be still in ending inventory at the end of May. So we subtract that. So the expected cost of goods sold would be $110,000. We subtract cost of goods sold, what the stuff costs, from the sales, what we charge the customer for that stuff, and the gross margin or profit on those items, total of $90,000. I have to pause 1 second. I'll be right back. Sorry about that little break. My dog needed to go outside. Okay, so we're at our gross margin. The next thing we want to do is determine our operating expenses. Well, they tell us the selling and administrative expenses for the month of May are $72,000, but they didn't include depreciation expense. So we need to add that because depreciation expense is subtracted on our income statement. So subtract the $74,000 from the $90,000 to get operating income of $16,000. Don't forget, we have interest expense during the month of $100, so that would reduce our net income. So our budgeted net income for the month of May, $15,900. Now, let's budget our balance sheet based on all this information. Well, we already know what we expect our cash balance to be at the end of May. We did that up here, $8,900. How much is our accounts receivables going to be? Well, they tell us sales are 140. Well, we figured out that sales on account are 140,000. 50% of those were collected during May, so the other 50% are still sitting in accounts receivables, or are still our balance in accounts receivables at the end of May. They're given to us that the budget of ending inventory at the end of May is $40,000. Now, we need to calculate our building and equipment net. How do we do that? Well, we say, what was our building equipment at the beginning of May? And according to the information on page 333, it was $207,000. Remember, you need to add any new building and equipment purchased. And back up here, remember, we purchased new equipment, so that would increase our building and equipment account. Any new depreciation for the month would decrease because we're reporting this net of depreciation. So the building and equipment at the end of May will have a balance of $211,500, or a budgeted balance. There's no information about other new assets, and all the assets that are currently on the April 30th balance sheet have been accounted for, either increased or decreased, or just reported at what we expect their new balance to be. So total assets are $330,400. Going on to liabilities and stockholders' equity. The only amounts in accounts payable are 60% of the purchases made during the month of May, because 40% of those were paid during May. So $72,000 would be the balance at the end. All the accounts payable on April 30th are paid off during May. Notes payable, the brand new note of $20,000 will be on our balance sheet at the end of May. Common stock didn't change during May, so that's still the balance. Retained earnings starts at a balance at the beginning of May of $42,500. Add budgeted net income of $15,900 to it. There's no information here about dividends being paid, so there's no subtractions from retained earnings on our budgeted balance sheet. So we're going to add the liabilities and stockholders' equity, and they should equal total assets. If they don't, you should find out why. Well, not should, you have to. So there's an illustration of how we prepare a cash budget, a budgeted income statement, and a balance sheet. The next problem I would like to look at is on page 339. It's problem 727A. And they give us information related to Shiloh Company, a wholesaler distributor of consumer goods. They give us information about their assets, liabilities, and parts of stockholders' equity as of March 31st. Then they go on to give us more information about their gross margin, actual and budget sales data, etc. What we are going to do in this problem is complete schedules for various months, not just 1 month. So let's take a look. So we're completing the master budget. Sorry about this. I don't have it just there. Almost. Here we go. So the very first item they want us to complete is the schedule of expected cash collections. So they give us the information in April. Cash collected, $36,000. Credit sales collected, $20,000. Total collections. So let's go back to our information on page 339 to find out what are the assumptions being used to determine expected cash collections from customers. And if you go to item C, sales are 60% for cash during the month and 40% on credit. Credit sales are collected in the following month of the sale. Okay, so the April cash collections, okay, would be 60% of $60,000 or $36,000, and then 40% of $50,000 last month's sales, because they collect any credit sales from the prior month in the following month. So March's credit sales would be collected in April, or $20,000, and that's where those numbers are calculated from. Let's go to May. In May, 60% of $72,000 or $43,200 are cash sales. 40% of April's sales are collected in May because they were on credit the prior month. So that's the $24,000. Total cash expected in May, $67,200. When you go to June, again, 60% of $90,000, the current month sales, are collected in cash in the month of sale. Cash collected, the remaining cash collected are from last month's credit sales, which were 40% of $72,000 or $28,800. So that is how this company predicts cash collections. So for the quarter, if you add those amounts across, they expect total cash collections for that 3-month period, the quarter, $206,000. In Schedule 2, they want us to complete merchandise purchase budget. Now, we need to find out, how do we do that? What are the assumptions? The gross margin in Part A is 25% of sales, so we know that. In Part D, each month's ending inventory should equal 80% of the following month's budgeted cost of goods sold. In E, 1/2 of a month's inventories purchased is paid in the month of purchase. The other half is paid in the following month. Okay, that's cool. Okay. In F, they go on to talk about, has nothing to do with our, nope, that has nothing to do with our inventory. Either does G, either does H. Okay. So, the first thing we want to determine is our budgeted cost of goods sold for each month. Now remember, sales minus cost of goods sold equals gross margin or profit. Sales are a 100% number minus your percentage of cost of goods sold gives you your percentage of gross margin. In item A, they tell us gross margin is 25%. So when you take sales of 100%, you have to subtract the amount percentage-wise for cost of goods sold that would give you a 25% gross profit margin, and that would be 75%. So the cost of goods sold are 75% of the sales number. So what we will do is from each month, April through June, is take the expected sales, April 60,000 times 75%. The budgeted cost of goods sold would be 45,000 for April. May, take 72,000 times 75%, 54,000. And then June, 90,000 times 75% will give you 67,500. What we are budgeting here is for how much we should purchase. So we're really starting from the end point and going forward. So we are budgeting the cost of the goods that will be sold. Now, in item D, it says each month's ending inventory should equal 80% of the following month's budgeted cost of goods sold. So April, we want to know how much an ending inventory should there be, because we want to know what's the cost of everything that will be sold, what's the cost of everything that will be left. Well, that should be 80% of May's cost of goods sold. So 54,000 times 80%. May's desired ending inventory will be 80% of the June's 67,500. Now, we don't have July's budgeted cost of goods sold on our schedule here, but we could figure it out. Sales for July are 48,000 times 75% times 80, and that'll be the $28,800. Now, if we add the budgeted cost of goods sold for April, that's the cost of the items that were sold, plus the cost of the goods that would still be available or still be in inventory at the end of each month, that'll tell us how much inventory we need in total. And so just add your budgeted cost of goods sold to your ending merchandise inventory amounts. Then that's everything we need. Well, we're going to start the month off each month with stuff already there. So subtract what is there ready to be sold as of the beginning of the month. So for the month of April, we need a total of $88,200 of inventory. But we start the beginning of April off with $36,000. That's in your book on page 339. So how much do we have to purchase? $52,200. Same with May. We have $108,000 need, but we'll start the beginning May off with the inventory at the end of April, $43,200. So we'll only need to purchase $64,800 of additional inventory. And finally, June. June, we start with we have $96,300. We start with $54,000, so we only have to purchase an additional $42,300. Okay. And then June, give me 1 second. Now, when we're looking at this from the quarter, we're not just looking at June. So we're saying, okay, what's the total amount of cost of goods sold for the entire 3 months? $166,500. What is the desired ending inventory at the end of that period of time? $28,800. Okay, where did we start the beginning of the quarter? So that would be the $36,000, the March 31st balance. So we're looking at it from a quarter perspective. So over the quarter, we'll have to purchase $159,300. In part 2, also, they want us to complete the schedule of expected cash disbursements for this merchandise purchases. So if we go back to page 339, letter E, 1/2 of a month's inventory purchases is paid in the month of purchase. The other is paid in the following month. The accounts payable at March 31st are the result of March purchases of inventory. So when we're determining cash disbursements related to purchases, March, we will be paying off, or I'm sorry, in April, we'll be paying off the entire accounts payable balance of $21,750. In April, we'll also be paying off half of the purchases made in April. We budgeted those above to be $52,200, so half of those, or $26,100, will be paid for. Going into May, the other half of the April purchases will be paid for, and then half of May's purchases of $64,800. $32,400 will be paid for in May. The other half are paid for in June, and then half of June's are paid for in June. So the total disbursement for each month would be those amounts added together for each month. And these are only disbursements related to buying inventory. So how much will they have to pay for overall for the 3 months? $159,900. Now, in part 3, they want us to get of course, get it together as a cash budget. So we're going to start the beginning of April off with our $8,000 balance as of March 31st. We already determined the cash collections from customers up here in part 1, $56,000. So that's added in. We've already determined the cash disbursements for inventory in that what we just completed, $47,850. Now, we need to see if there's anything else we're paying for. Go to part F. Monthly expenses are as follows. Commissions, 12% of sales. Rent, $2,500 per month. Other expenses, excluding depreciation, 6% of sales. Assume that these expenses are paid monthly. Depreciation is $900 per month. It includes depreciation on any new assets. So we're going to have to do some calculation here. Now you could do these separately. The first is 12% of the month's sales. So 60,000 times 12% would be for commissions. Then there's a flat $2,500 a month. And then there's other expenses that are 6% of sales. So take 60,000 times 6%. So 3,600 plus 7,200 plus the 2,500 will give us cash payment for expenses in April of 13,300. And you would do that same computation for May and for June. And if you wanted to take a shortcut, since your computation is a percentage of sales, you could say 12% plus 6%, 18% of sales are in expenses. So in May, you could take 72,000 times 18%. Add to that result the $2,500 of other expenses, 15,460. Now in Part G, they tell us in April only they paid cash for a piece of equipment. So we'll include that as a cash disbursement. So our total cash disbursements would be those three amounts added together. You could then subtract your cash disbursements for the month from the cash available. So for the month of April, there'll be a positive result or excess cash of $1,350. But since cash disbursements are greater in May than cash available, there'll be negative $2,410. June, there'll be a positive $15,140. Overall for the quarter, a positive $5,140. Now, the next part of our cash budget says, okay, are we borrowing or paying any loans off? And in Part H, management would like to maintain a minimum cash balance of at least $4,000 a month at the end of each month in their cash. The company has an agreement with a local bank that allows the company to borrow in increments of $1,000 at the beginning of each month, up to a total loan balance of $20,000. The interest rate on this loan is 1% per month, and for simplicity, we will assume that interest is not compounded. The company would, as far as it is able, repay the loan plus accumulated interest at the end of the quarter. Now, at the end of April, this company only has $1,350. It wants to maintain at least $4,000, but they could only borrow in $1,000 increments. So they're going to have to borrow $3,000 in order to have a balance above or at $4,000, so $4,350. They'll begin May with that $4,350 balance. Now take a look at the end of May, they have a negative $2,410. So they want to maintain at least $4,000. So they're going to have to borrow $7,000 in order to have an ending cash balance above $4,000. They can't borrow the exact amount to have them at $4,000. They can only borrow $1,000 each time. So they have to go to $7,000. Starting in June, they have a balance of $4,590. And they end up with an overall cash available because of that of $15,140. Well, they don't need that much in cash. They only want to have a balance of about $4,000. So they could pay off $10,000 of that loan, all $10,000. But what you need to keep in mind is not only will they pay off the loan at the end of June, but they also have to pay any interest associated with borrowing. And we just don't go 10,000 times 1% interest times 3. No, because they borrowed $3,000 in April, and they would have borrowed it, they told us, as of the beginning of the month. So let's say at the beginning of each month. So when they didn't wait till the end of the month to borrow that $3,000, they borrowed it April 1st. So interest on $3,000 would have accrued April, May, and June. So we would compute interest for the $3,000 part of the loan, 3,000 times 1% times 3 months. Again, with the $7,000 borrowing, they would have borrowed that May 1st. So to compute the interest on the $7,000 portion of the loan, 7,000 times 1% times 2 months. Add those two together, and that's the amount of interest they had to pay on the overall borrowings. So they would end up with an ending cash balance at the end of June of $4,910. So that's how we complete cash budgets. We need to have these assumptions in order to complete them, and they're so important in business to do, especially so that you could predict any borrowings you may need. Now, in 727A Part 4, they want us to prepare an absorption costing income statement similar to the one in Schedule 9 in the chapter for the entire quarter. So the first thing we're going to do is start with sales. Not how much cash we collected, but how much in total sales were there. We're doing an income statement, right? $222,000. Now, I'm going to go back up here. Remember, in here, we predicted cost of goods sold. We could use the information from our purchases budget now to complete our income statement. Beginning inventory of $36,000. How much did we expect to have to buy during that period? $159,300. How much do we expect to have left over? $28,800. And there's our cost of goods sold, $166,500. We budgeted that. Subtract your cost of goods sold from your budgeted sales. $55,500 is your gross margin, gross profit. Take to list commissions, rent, depreciation, and other expenses separately. We'll take 12% of total sales, $26,640. 3 months of rent at $2,500 a month, $7,500. Depreciation, $900 a month. We bought the equipment in April, so there'll be depreciation on April, May, and June. And then our other expenses would be 6% of $222,000 in budgeted sales, $13,320. So total budgeted expenses, $50,160. Subtract that from gross margin. Sorry about that. That is your operating income. Now subtract your interest expense that we calculated above, $230. Budgeted net income, $5110. And the little asterisk says, remember, cost of goods sold is 75% of sales. So you could have just taken a shortcut there if you just wanted to quick get your cost of goods sold amount. The final thing we have to do is a budgeted balance sheet. A little bit more involved, but very similar. You had to do a lot of stuff to get here. And that's why you take this in steps in your master budget. So we have current assets. We already determined the final balance of cash. We did that up here in our cash budget. At the end of June, $49.10. So I know I'm kind of flipping around here. Accounts receivable, remember, will be 40% of June sales of $90,000, $36,000. Inventory, we determined already the ending inventory amount up here of $28,800, right there. It's 80% of July's cost of goods sold. Going back, So our total current assets are $69,710. Building and equipment starts with a balance at the beginning of the quarter of $120. We bought some new equipment of $1,500. And we depreciated our equipment and building, $2,700 during the quarter. So the building and equipment net, $118,800. So total assets, $188,510. Accounts payable, remember, will be 50% of the purchases made during June, because half of them will be paid in July, and that was done on a schedule up above. You can take a look at that. $21,150. There is no notes payable. We paid them off, right? We borrowed and paid off, and there are none existing as of March 31st. Our common stock is still at 150,000. That's given on page 339, March 31st. Retained earnings is also given of 12,250 at the beginning of April, end of March. And we accounted for the net income for the quarter of $51.10. So we must add that to retained earnings. There are no dividends, so retained earnings, $17,360. Total stockholders' equity, $167,360. Add that to your liabilities. They equal total assets, $188,510. So that's a great illustration of the entire master budgeting system and how we complete those steps. And it's very similar to what you'll be doing for your graded problem. So if you have any kind of questions, please post them to the discussion board.